Here we are, class part 3 of our gain or loss, chapter 10 explanation. We've looked at several times when the rule that you recognize gains or losses is not followed. Exceptions to the rule, you might say. We looked at like-kind exchanges, which means that the realized gain and the recognized gain are not the same almost in every case. And we looked at wash sales where losses are disallowed. Now we're going to look at a situation where the tax law provides for specific gains are not recognized. So you'll have a realized gain but no recognized gain, or at least not entirely recognized. So sale of principal residence is probably the most common of these, of all the exceptions, and and is well known. Most people know that when they sell their principal home, principal residence, that they do not have to recognize the gain on that. The flip side is that also if there's a loss, you don't get to recognize that either. But there's some restrictions up to $500,000 for married filing jointly. Okay, and you have to use the home as your principal residence for 2 of the previous 5 years, which means you can only have one of these. Okay, you can't have, if you may live in 2 different houses, 2 homes, you can't have 2 principal residences. So this will only apply to one of those 2. If there is some time that you rent it out, you may have to reduce your exclusion by the time that you are renting it or made another use for it. Also, if you use your home office, remember we talked back in an earlier chapter about a home office, the part of your home that's considered a home office is not your principal residence. So while you could have an excluded gain on the principal residence part, the part that you use for home office is a commercial property and does not qualify for that under those rules unless you don't use it for a couple of years so that the home office deduction goes away and you can still use the principal residence exclusion. Okay, involuntary conversion. What we're talking about is you end up without your property, you end up with what really is a sale, but you didn't mean to because something happened that you didn't want to have happen. Condemnation, something, your property burned or whatever. So how does the gain happen for that? Well, the amount, say your house burns down and the insurance pays you more than your adjusted basis. So the amount you realize is more than adjusted basis, so you have a gain, okay? Or it can be a loss as well. So the point is usually what do we do with the gain? The losses on those types of situations, depending on if they're a personal property, then they qualify as a casualty or an itemized deduction potentially, and if they're a business property, you get to deduct the loss. But if it is a gain, is rules that allow you to at least postpone the gain, kind of like a like-kind exchange. It is elective, it's not required like kind exchange treatment. Okay? Unless you receive it as a replacement property. So what you're looking at is your new basis in the property that you replace. Okay? It's same as this looks familiar, we subtract the postponed gain. So if you have a business property, you must replace it with a business property. Or if it's anything else similar in service or use. And it has to be reinvested, right, for the last day of the third year in which the gain is realized. So you do have some time. It's not like it has to be reinvested right away. That's if it's condemnation. You can only get 2 years if it is any other type of conversion. So condemnation, case land is condemned. What that means is the local government needs that property to build a road or a bridge or something, and so they condemn it, which means they basically say you have to sell it to us. But according to the Constitution, they have to pay a fair market value for that. When they do that, so they gave him $75,000. Her basis is $34,000. So she didn't want to sell his property; she's forced to. So it's an involuntary conversion. Her realized gain is $41,000. She's got $75,000 to spend from the government. As long as she spends all 75 or more on new property that has a similar use, business or investment, and she gets 3 years because it is a condemnation, then she will not have any gain. She'll postpone all the gain. And her basis would be then the $41,000 typically, unless she spends more than 75. Warehouse insurance company reimbursed $210, so adjusted basis is $140. He receives $210. Realized gain is $70. You can postpone all of it as long as he pays at least $210 for another warehouse. Got 2 years. If he pays less than that, $210, anything he spends less is considered boot and would be gain, never more than the realized gain, but it could be up to the $70,000 realized gain. So if he spends more than $210, then he's good, all right, and his basis would be the new property minus the postponed gain, all right, plus whatever else he spent on the new property. Okay? So if he spends more than $210, it's money out of his pocket, so it's obviously going to add to his basis. All right, some special rules if this is a federally declared disaster area. Okay? So that's basically the idea of involuntary conversions. I'll wrap up our discussions of gain or loss and when the exceptions are to the general rule of realizing gains and losses.